The country we thought was an emerging economical juggernaut big enough to rival the US might have more problems than it lets on. With $1 trillion in debt, failing banks, and a collapsing economy, all of China's successes in recent years might be very short-lived. Confused? Don't worry, we'll fill you in. Today, we're going to be looking into just how China got to this point and what this means for their future. But before we can do that, we'll have to look at the past first. China had the perfect solution when the 2008 recession hit the global economy. They started injecting money into the economy to kickstart what would become the biggest railway network. Not only did this save millions of people from unemployment and save multiple industries that provided the materials, but in just one stroke, it had also solved the problem for their existing railway systems that were not able to keep up with the number of passengers. But soon, the country would realize that what had seemed like a genius move was actually a death trap that can completely destroy their country's economy. Today, China's high-speed railway system has a track length of over 40,000 kilometers, which is about 10 times the size of Japan's, and connects almost every major city in China. In 2021 alone, it grew by 2,168 kilometers and carried a total of 1.7 billion passengers. This means that 2/3 of the world's entire rail network is now in China. And in the next 15 years, they plan to almost double the size of their high-speed rail network. For a railway system that is already big enough to circle the globe, this statistic is almost impossible to imagine. With new state-of-the-art trains introduced as recently as last year, capable of going up to 350 kilometers per hour, the Chinese are taking the fast track in not only traveling around their country, but also in leaving behind the rest of the world technologically. The goal was a more urbanized and economically developed country. With easier and more comfortable transport, you can be at any place almost just as fast as you would on a plane. By all means, it should be an absolute success. So then, what went wrong? For starters, pouring money into such an expensive project when millions in your country are living in poverty is bound to draw criticism. Ignoring the poverty concerns would soon come back to haunt China, but we'll get into that in a moment. Initially, the railway system was making bank. But back then, the railway system was limited to lines between Beijing and Guangzhou and Beijing and Shanghai. Eventually, they covered all the major cities. If China had called it a day at this point, then it would have been a complete success from a financial perspective, but they decided to do the opposite of that. Already, the HSR had become an inseparable part of China's economic engine. In a mad rush to cash in on the dividends the major city railway lines were delivering, other provinces blindly tried to copy this. They missed the completely obvious fact that the rest of the country can't bring a similar volume of passengers as these metropolitan giants. Most of the trains are running at less than 40% of maximum capacity, which isn't nearly enough to break even. For example, they spent over $22 billion to build an 1,800-kilometer line in the remote Xinjiang province. The railway line is currently operating at about 6% of its break-even capacity. People simply didn't travel enough in the rest of China, especially with such expensive fares. The cost of traveling on the high-speed railway was already sky-high to keep up with the cost of running the trains, but fares became even higher when passenger turnout fell, making a vicious cycle. The high-speed railway system cost approximately 3 times more than conventional railway to make, only to be nearly unusable for the general public anyway. On top of that, in their rush to build the railway system in record times, it seems the company may have allegedly bypassed a few safety precautions. The collapse of a 300-meter-long rail section near the Yangtze River did nothing to soothe the already building concerns of the public. And then there's the corruption. China's ex-railway minister recently received the death penalty for corruption, and even though the details of the allegations are unknown, it has been reported that they contain claims from bribery to sexual coercion. But this was only the beginning. Further investigations revealed that about 5 billion yuan have seemingly disappeared from the money poured into the Beijing-Shanghai railway alone. All of this could only mean one thing. About 4 years ago, 60% of the high-speed railway operators each lost a minimum of $100 million. The least profitable operator in Chengdu lost $1.8 billion alone. Economists were already predicting an impending debt crisis for the country if this went on. Long story short, the railway system is bleeding money. In the first half of 2020, it was losing almost $77 million a day, racking up a total of about $900 billion in debt. But even that number is misleading. Since about half of the costs of the railway system were taken up by local governments, the total debt is probably close to twice that number. A recent evaluation by Goldman Sachs has even reported the total debt by local governments is close to $8.2 billion, which is about half of the country's GDP. Imagine if that money had gone to public welfare, right? The combination of this hidden debt, combined with what the state had to pay, is proving to be deadly. Investors and the public, in general, don't exactly have a lot of faith in Chinese state-owned companies anymore. And on top of that, with the local government so deep in debt, many of them are finding it challenging to finance other sectors like education and law enforcement. On top of that, bond yields started to free fall and profits became non-existent. The railway company decided to liquidate RDF to stop paying dividends to the investors. Set up in 2014, the RDF initially offered preferred shares with steady returns to investors. A fixed steady return of 5.5% was offered to the first 4 banks to invest in RDF. Any bank that came later would get 5.32% returns. But what probably seemed like a sweet deal back then has revealed itself to be a death trap. Record losses since 2020 due to coronavirus restrictions mean that the railway company doesn't exactly find it easy to pay what they promised. To make matters worse for the investors, the interest rates on the 9 20-year bonds offered by the RDF crashed from a high of 5.78% in 2014 to 8.97% in 2020. The problems created by China's reckless spending are already affecting other sectors of the country. Soon, they might cause a complete crash of everything. The railway lines are dependent on more and more debt to continue running, but they just aren't making enough to pay it back. And at this point, the country is having to borrow debt to pay off existing debt. Of course, the government isn't just going to let that happen. The state government has issued a warning to the operators to bring their debt down to reasonable levels by 2035, so they are trying to reach a solution. But China is also trying to recover economically from the coronavirus, and with the railway being such an integral part of the country's economy, they just can't stop the production of new railways completely. The other tactic the country is using is to sell its railway technology to other countries, but this puts those countries so heavily in debt that it has come to be known as debt trap diplomacy. It's not the most morally correct option, but it's the one China chose. But with recent examples of countries like Sri Lanka facing the consequences of having dealings with China, the rest of the world is growing more and more wary. Needless to say, China is in a tight spot. Some people are calling the railway crisis the next Evergrande, but the total debt is almost 3 times as much as what the property company owed. While the government is trying to cut back on railroad development, it can't do so all at once. With so many people getting employment by the railway system and it being such an integral part of GDP growth, pulling back all at once will trigger a recession. On the other hand, continuing at the pace China has been going on in the past will mean a certain economic collapse once the debt bubble explodes. It's a tough balancing act, and it will definitely be interesting to see how China carries it out in the near future. That's all for today's video. Do you think China will be able to solve the railway problem, or will it go crashing into a trillion-dollar disaster? Let us know in the comments below. And if you like this video, make sure you check this one out as well. Bye for now.